Welcome to another episode of the Know Better, Do Better series. We have an exciting guest for you today. But as always, we start at the top of the show with our trends, taxes, and tea. And as you all know, my fearless co-host, Chloe, is always the leader in our trends, taxes, and tea. So Chloe, what do you have for us today?
Yeah, this tea is hot. It just came off the press. But basically, in a recent interview, the HUD Secretary, Marcia Fudge, she called student loan debt a barrier to Black home ownership. And so just to give you some statistics about that, about 45 million Americans collectively owe 1.7 trillion in student loan debt. And it definitely disproportionately affects people of color. Black borrowers typically owe about 50% more than white borrowers. And then after 4 years with interest and everything that accrues, Black borrowers can owe up to 100% more.
Wow.
So that's a lot. And just, with everything with student loans and just the education getting more and more expensive, home ownership rates among Black Americans has really declined drastically in the past 15 years. And while homeownership rates for Asians and Hispanics have gone up. So she really wanted to call this out and say this is a big crisis. This is something we need to pay attention to. And as a result, the FHA, they basically announced some new calculations related to monthly student loan payments when it comes to qualifying for a mortgage. So this new calculation is basically going to favor the borrowers and kind of is designed to help prevent their debts from being overstated, which can help them boost their chances of getting a mortgage.
I think this is a really big deal because the conventional loans have been doing the same calculation for quite a while. The FHA now has decided to kind of jump on board. It's going to allow you to use, as an example, if you're on an income-driven repayment plan, that payment is going to be tied to your income. So you're going to have a low payment if your income is lower, which is going to allow you to have a lower monthly debt to income ratio, which is what most companies are looking at. The FHA has been doing 1% of your total loan balance, and that throws things off quite a bit, especially if you have a really big loan balance and you've been on one of these income-driven plans where your loans have been growing year after year. So kudos to the FHA for making that new change in the calculations. As we all know, there's been a housing boom over the last year. People have been locked indoors with one another during COVID and need more space if they're going to be working from home. So I think that's a pretty big deal. And I think it's also worth mentioning that for homeowners in general, a lot of people are like, well, what if they cancel student loan debt? What if they do 10,000? What if they do 50,000? I saw an interesting stat recently that said if $50,000 of student loan debt was canceled, that would wipe away the average student loan payment of about $387 per month. So if you took that and applied it to a 30-year mortgage at 3%, that's about $92,000 more that someone could spend on a house for the average borrower. So as we kind of talk about these things, there's the good side of forgiveness, and then there's also the bad side of forgiveness, because if we forgive it all, what is that going to do to our economy? But there are some different ways to be thinking about how all the different things that are happening as it pertains to home ownership and the markets and student loan debt can affect you individually and also affect our economy.
Yeah, and our very first episode that we did in the series, we talked a lot about home ownership. So if you are thinking about buying a house, if you're a first-time home buyer, we encourage you to go back and listen to that episode.
For sure. So who do we have today, Chloe? If someone's watching on YouTube, they're like, hey, there's someone in the background here that I see, but haven't heard anything from yet.
Yeah. So I'm super excited. So I'm going to turn the tables a little bit. So I'm going to actually, our topic for today is college and student loan planning. And so, you all know that Lauryn's an expert when it comes to student loans. And so I'm going to turn the tables and interview her. And we also have an amazing guest. Her name is Nannette. And so we'll have her introduce herself as well. And she's the go-to person for college planning. So I just figured, those are two kind of good topics that go well together. And it's a good opportunity for me to interview the two of you about college and student loan planning. So Nannette, if you want to introduce yourself, just tell us a little bit about yourself, your background, some of the work that you're doing.
Great. Thanks, Chloe. Thanks, Lauryn, for having me today. I'm really excited. I have a lot of strong opinions on this topic, as I shared with Chloe and Lauryn earlier. So I'm excited to share them with everybody listening. My name is Nannette Kamien. I'm a certified financial planner and divorce financial analyst for a firm called Cultivating Wealth. I owned my own firm for almost 5 years, and I did a lot of work with mostly Gen X families, thinking about how to save for college, how to plan for paying for college, how to recover from getting themselves in trouble with student loans. Lots of honestly older people who borrowed to send their kids to college. And so I really got interested in the topic, trying to prevent people from making all the mistakes that I know Lauryn works with, people on the other end trying to clean it up. Because, really paying for college is one of the big expenses in any family's life. And it's not something that people plan for enough. And, hopefully working with somebody like us can help them, make smart choices and plan ahead.
Yeah. And something that Nannette didn't mention is that she's also an author. She wrote a book called Crazy College Money. So I'd love for you to tell us a little bit about your book and kind of what inspired you to write the book.
Yeah. So it's available on Amazon, called Crazy College Money. I wrote it about 2 summers ago. And honestly, it was because I realized that not everybody could afford to pay for my services. And a lot of people didn't honestly want to hear what I had to say once they hired me. So they felt like they were spending money and they didn't want it. I wasn't giving them any good solutions that they liked. So I literally just sat down and I took everything that was in my head and everything that I had learned working with these families, and I put it in a book. And I said, you know what, I'm going to put it out there as a cheap way for people to get information and spread the word with really what I had been evangelizing, all this time. It was very quickly written. It was literally like a dump of just knowledge. And I sat down and I just wrote, and I had to get it out. I felt like it just like leapt from my fingers. and I was like, how can I easily publish a book, get a cover, get it typeset, just put it out there for people to access. Because, everybody needs this information, and there's not a lot of good places for people to get it.
Yeah, you struck a nerve with me there. Not a lot of good places to get information. There's so many people that, just woke up and decided they're an expert on a topic versus like actually, deep dived into something. And it's so great that you wrote a book to be able to share information from a credible source, someone who's got an education around this, who's helped people, dug into the nitty gritty of people's personal finances and figured out what is the proper way to go about this. So I am excited for all the people who are going to pick it up, purchase it, and invest the time so that they can know better and do better.
Yeah, and we'll put a link in the show notes for the book. And then Lauryn, I know we've all talked to you every single episode, but I want to hear more about how you got interested in student loan planning.
There is a story. There's always a story with me. So the very long story short is that as I opened my firm, the first client that came to me that kind of came organically, not, a friend or a family member, because we do a lot of that. Initially, we're opening like, oh, you're breathing. I know you. Come on, I can help you. But the first person that found me just kind of out on her own came with $334,000 of student loan debt and about $140,000 of income. And all I could think about was like, man, I am ill prepared for this. They didn't teach me anything about this on my CFP studies. So it's like 6 figures is a big number, especially I think in communities of color where, if I could just make it to the 6-figure mark, then everything will be okay. It's like a magic switch is going to flip. And of course, now being a financial planner for a while, I know that is not in fact true, but I was definitely thinking that 6 figures was good earnings for a single individual living in a small cost of living city or a small cost of living state and city. And here she was with student loan debt that was 3 times her income. And it was pretty much like a large mortgage payment every month. And she was trying to figure out how to save and how to do all these other things. And I had no earthly idea how to help her initially. So I went down a rabbit hole of learning information, Googling around. I found Heather Jarvis, who was a big time lawyer, who is basically a leader, a thought leader in this area, and actually did a lot of the work, laid the groundwork for the federal programs that we have available to us from income driven standpoint today. Met her, went to some of her classes, and then decided that's not enough. I want to work for you, Heather. And she's like, but I don't need anyone to work for me. I'm a one-woman show. I'm good to go. And I'm like, no, you need an intern, because I need to deep dive into this stuff and get a better understanding, because there's no one that knows anything about it. And from there, I actually ended up interviewing. I started my podcast and interviewed another gentleman named Travis Hornsby, who is the owner of Student Loan Planner. And he learned about my work with Heather and brought me on board with him. So I've been doing student loan consultations for about 3 years now, 1-hour consultations, and have, like I said, just kind of gone further and further down the hole of learning more about student loan debt and really being able to make an impact in people's lives in just 60 minutes, because student loan debt can be so crippling. So that is the long story short of how I got into the industry.
Yeah, and we will also put a link to a student loan planner in the show notes as well, because you can schedule a consultation with Lauryn, and there's a lot of other student loan planners that can help you as well.
Yes, I've sent people there too.
Yeah, Lauryn's my go-to person for sure when it comes to student loan planning. So I wanted to dig into college planning first, and then we can get into student loans. I feel like if we do the planning ahead of time, then maybe we won't have the student loan issues.
Yeah, isn't it like
that's
Benjamin
what we hope?
Yeah.
I was gonna say, I think it's Benjamin Franklin that says that an ounce of prevention is worth a pound of cure, right?
Mm-hmm. Yeah.
So yeah, we definitely would rather have the Nannette side of the story first, so that there is no need for the student loan planning side of things.
Yeah. Yeah. So Nannette, just to start off, I know, a lot of people just talk about, saving for college, and, when you first have a baby, like that's maybe one of the things that you think about. How can I, set my child up so that they don't have to pay all these student loans that I'm paying? And so just, what are some of the options that are available to save for college, and how do you recommend kind of balancing that with retirement savings and other financial priorities?
Yeah. And I think you brought up a good point. Like, a lot of parents of young children these days, we're still paying off our own student loans. Okay. I have student loans from grad school. Almost every client that I know that has young children that has not grown up sort of in a more wealthy family has some sort of student loans, whether from undergrad or graduate school, that they're paying off. And, it's really easy to say, oh, don't save for your own kids' college until you've paid off your own student loans. But I don't listen to that. And a lot of people that I work with don't want to listen to that. And so it is a balance. And I try to tell people that you need to take care of your retirement first. You need to take care of, saving for, owning a home or getting out of other kinds of debts before you save for your kids' college. But college is such an emotional a decision for a lot of people. For a lot of families, if they were their first in the family to go to college, they want to provide that for their children. So they really feel an emotional need to save. And unfortunately, if you've got a small child, you're paying daycare, you're probably, you're owning your first home, your earnings maybe aren't where they will be in 10 years. And so it is hard to find the money to be able to save. Typically I recommend that people save in some kind of a special savings account for college, whether that's a 529 plan or a covered education savings account. It is nice to be able to have those earmarked savings for college, because you do get tax breaks for these kinds of savings. And some savings options are better than others when it comes to financial aid down the road. So that's what I help people look at when they're thinking about saving for college. Unfortunately, right now, it's hard to predict how much college will cost 15 years in the future or 10 years in the future. And if you plug it into an online calculator, kind of like retirement, you come back with, you need to save $5,000 a month for the rest of your, until your kid is 18, so that they can go to a state school, and, and it's, then that's for 4 years. Right. And so it is overwhelming when people think about trying to save that much money. Almost nobody says, oh, I've got an extra couple $1,000s a month. Once you've got 2 kids, it compounds itself. So, I usually tell people, figure out an amount that you can save. Don't worry about what it's going to cost in the future, because that's a futile exercise. What can you save? Put it aside, make it automated, leave it alone. Don't even think about it.
Yeah, that's so true. And, just even we talk about saving and investing all the time. It's just the earlier you can start, the better. Those little amounts add up over time. And so, the important part is just, saving something and starting somewhere.
Yeah.
Yeah. And so this is another thing I was curious about too. When should parents start having conversations with their children about, choosing the right college or whether college is even a viable option? How early do you think those conversations should start?
Well, I actually want to take a step back even before that, because what a big part of the first, say, half of my book talks about is really parents digging into their own funding philosophy and what they want to do for their kids. Because, a lot of people, like I went to school, I got scholarships, my mom paid some out of pocket, I got loans. I had a work study job, and I was able to sort of get myself through school and get out of college without too much debt, right? The cost of college is such that it's really, really difficult to do that now. And so parents oftentimes have this mentality that something can be done that really can't anymore. So I ask parents to think about, did they borrow money? Did their parents pay for everything? And maybe they feel this guilt that they need to do that for their kids. Do they want their kids to work? Do they want their kids to take out loans? Do they want their kids to have scholarships and those kinds of things, and talk to each other about it too? Because oftentimes I hear couples that they have very, very different backgrounds and how they got, through college, or maybe they didn't go to college. One did, one didn't. And it creates a lot of stress in the family if the parents haven't talked about it first. So that's what I would say is the first step, is parents think about what you want to do and what you feel like is something that that you should do for your child, right? And then when your child gets to be somewhere, I would say in middle school, I think that's a good time to start having the conversation. I call it having the college money talk. And let your child know, have you been able to save? What do you feel like your savings prospects are for the next 5 or 6 years? Do you feel like they should, stay in state so that they could live at home, or should they go to a community college for a few years? And at that point, you sort of have an idea whether, is your kid academically inclined? Like, are they going to get academic scholarships or not? Because you can't count on merit scholarship aid for your child who is, just an average student, and that's totally fine. And there's a place for an average student to go to school too. But you can't be counting on tens of thousands of dollars scholarships if your child's not going to be able to earn those. That's too much pressure on them. And I think by middle school, you kind of have an idea of whether or not they'll qualify. And I think they're at an age where they should start understanding the family finances and understanding how much college costs and what a big decision this will be.
And I think you just gave up.
Sorry.
I think you just gave 2 really great nuggets. The first being that the parents should have conversations about what their philosophy is. I think so often you wait until the last minute, and then the kid is kind of like assuming mom and dad got this taken care of. Yes. Like, it's all going to be fine. And then you find yourself kind of being drug along by what their goals, wishes, and desires are versus what you actually can do, plan to do, and to think about yourself first in that process so that you can really nail down, like you said, whether they should go to school or not. I mean, go to work or not while in school, or how much education, or in state or out of state. Yeah, to have kind of those basic parameters parameters laid for yourself so that you can facilitate a conversation with your children is so, so important. But then also, like you said, bringing them into the conversation starting in that middle school age, because if they don't understand how money works, they don't understand that this is not free, even, especially if they go to a public school now, they show up and school is taken care of and there's not a lot of conversation about how much school costs. But then all of a sudden there's college and it's just not free. They need to know that there's a price tag, a price tag attached to that, and that there's value. And so if this is something they want to do, it's not something you're just naturally entitled to do. And let's talk about how to get you there and how to continue to prepare you in that direction. So that's great advice.
Yeah. And I remember early in my career, we met with a couple and we were asking those questions about, what is your philosophy on saving for college? And, what do you want to cover? And the wife, education was really important to her family. And she was like, we will do anything. I will sacrifice my retirement to make sure my kids go to the best college. And the husband was like, what?
Yeah. Don't have that conversation the fall when they're applying to school in their senior year. That is not the right time to have that conversation.
Yeah. And then also, like you said, just setting those expectations with your child, and then introducing them to the family finances and it's just so they don't think that they can go off to some private school out of state and that's not realistic for the family finances.
Right.
Yeah.
And party and be on the 6-year plan, because a ridiculously high percentage of students don't graduate in 4 years.
Yeah.
So, it's only like 20% or something that graduate in 4 years. So,
oh, wow.
It's really low. Yeah. The graduation rates that are reported by the government are usually 6-year graduation rates, and they're still only in the 40s. At least last time I checked, they were. Yeah. They're ridiculously bad. So, and that's another big problem from a student loan perspective, especially as students who start and then never finish, because not only do they have the debt, they don't have the education to make up for it and get a good job and pay off those loans.
Wow. And I think that kind of begs the question too, like whether college is actually a viable option. And I wrote an article for Business Insider, and we can put that in the show notes about, I don't feel like college is, something that everyone has to do. And there are so many different careers that you can go into that don't require a 4-year college degree. I work with clients in tech. I have several clients who didn't go to college and didn't get a degree. They went to a coding school or a coding boot camp, and they're making a really good living. And so,
I think
options.
Well, I was going to say, I think it's a disservice that our schools do for our children right now, because there's so much tied up in, all these schools are like, our seniors are going to Harvard and Yale and USC and, all these big name universities, and they care about what names they can put up on their marquee when the seniors are graduating, right? They don't care if your kid's going to go into debt or not get a job or, whatever. And I do think that's a huge disservice. It is the sort of, I talk about this also in my book, like the college, like marketing media complex and how everybody is bought into this name on the sweatshirt or the sticker on the car or the university on the marquee. And it's just, it's not, there are always going to be those schools that, people pay full price to get the name on the diploma. And, you could argue that it's not worth it, and it's definitely not the right path for everybody.
Yeah. And so what do you say to parents who are late to the conversation? Let's say you do have teenagers and you haven't prepared and haven't had those conversations ahead of time.
And those are the ones that don't want to hear what I have to say. Honestly, because there is the message that you can't afford to pay for your child's school. If you have, I often get prospects that come to me with a lot of debt, not very much income. They're overspending every month, and they want to talk about how can we get more financial aid? And, the answer is you're probably not going to, and it is it's an unfortunate truth for parents to have to swallow, and they go away and they don't hire me, and that's fine. But what I need to say to people is educate yourself, because the system makes it too easy to sign on the dotted line and for the parents to borrow the full cost of education for their children. And then the parents are in loan trouble because they don't care. The government doesn't care if you can pay those loans back. I see parents all the time in these Facebook groups that I'm part of. Literally the first bill is coming in this time of year, June, July timeframe for the fall. And they're like, where do I get scholarships to pay for my kids' school? And mind blown. Like, seriously, you just signed up to pay 50 grand a year for your kid to go to XYZ university and you don't know how you're going to pay for it. At least if I can get parents before their kid's senior year, before they apply, their kid doesn't have their heart set on a college. They don't have the sweatshirt already bought. But the further on you get and the more, down that path you get, the further that train has gone, it makes it very, very difficult to turn around.
Yeah.
It is such a tough place to be in too. Like as you said, it's so emotional. I think parents feel like, oh, I failed my child by not having saved. Or like you said, if they have not included the child in the financial conversation of the household up to this point, it's like, oh, my kid thinks I have it, so I have to pretend like I have it. And so I have to figure out how to afford this come hell or high water because this is my child. When they had 18 years to save for it and they didn't. Yeah. And it's a tough pill for some people to swallow, to say like, I truly can't. I'm going to sacrifice my whole retirement if I let my child go to, like you said, very fancy, expensive school, ABC, versus saying, hey, we might need to have a conversation about community college or in-state or, you taking on the student loan debt, et cetera.
Yeah. Yeah. And I mean, it is sad because parents don't want to say no to their kids. It's not the kid's fault. The kid doesn't know any better. You need to educate your children about what things cost and about, what the process is. So you need to become educated yourself. You can't be that parent who is asking, for scholarships the summer before your kid goes to school.
Yeah. And it really goes back to just, I think this is a good opportunity for parents to teach their children about finances, and what you can afford and what you can't. I think some of those lessons can carry, throughout your child's life if they see that you can't just borrow your way into getting everything you want.
Right.
And you really should, make a deliberate, thoughtful process or decision when it comes to, the process of planning for college education.
Yeah, because beyond purchasing a home, it's probably the second most, the biggest expense that you'll have as a family. It can very quickly turn into a very bad decision that will linger forever.
Yeah. And I know you mentioned financial aid. Can you speak a little bit, on that and just kind of the landscape? Because I know I qualified for grants and I did work study and all of those things back in the day, but I'm pretty sure that it's changed since then.
Yes, absolutely. And again, that's what I talk about. Like the parents who are making these decisions have this idea in their mind about what the system was like 20, 25, years ago when they went to college. At least for me, you were probably many fewer years than that, but parents of 17, 18, 19-year-olds, they have this idea of financial aid. And what I tell people is like, there is no financial aid fairy. Okay. Parents think they're going to fill out this application for financial aid. The financial aid fairy will come down and write a big check and they won't have to pay very much for their kid to go to school. And that just doesn't happen. I mean, the bottom line is that if you make over, say $100,000 total for your family, you're probably not going to get any like grants or government sponsored financial aid. That's just the way the income formula works. It doesn't matter even how much assets you have, how much you've saved for college, how much retirement assets you have, or what's in your home equity. The income is the biggest factor in determining the need-based financial aid. The other side of the coin is that there's the sort of the merit-based financial aid, and that's where your child needs to find a school that wants them. And if they find a school that wants them from whether it's an academic or sports or some sort of talent, they play the I don't know, some weird instrument, or they have some acting talent, or, whatever it is, you need to find a school that wants your child, and then they'll get merit scholarship money, which means they get a discount on the sticker price of college. So they're two very totally different, I guess, systems of financial aid. But understanding what goes into the federal, financial aid FAFSA process is very important. And then also understanding how to find those schools that want your child. I think, again, parents need to educate themselves on the whole system and understand sort of where they fit in that system.
Kind of feels like taxes to me. I think a lot of people go to accountants and they're just like, what? I have to pay taxes? You suck at your job. Like, how dare you tell me I have to pay taxes? Can't you figure this out?
Right. It is
income. You got to pay taxes.
Yes. And it's an unfortunate thing that, again, there's some government formula back at, like there's a 30-page document that explains it if people want to go Google it. But, it's the fact that you put all these numbers in and it spits out this number that says, this is how much you can afford to contribute every year to your child's college education. And for somebody making $100,000, it's like 25 or 30 grand a year. Nobody that I know that makes $100,000 a year has an extra 30 grand laying around. That's just the way the formula is. And so there people, complain about it, like, just like they do about taxes, but you need to learn to work within the system and understand how those numbers are generated.
Yeah. And so just outside of, just not planning ahead, are there any other common mistakes that you see when it comes to college planning?
I think it has to do with the whole financial aid and scholarship fairy, is that parents, I think they think that there's this big pool of money out there that if they just, applied on the right website, or if they just, found the right book or whatever, that somebody would come down and give them all this money. And that's just not going to happen. And parents think that, oh, I'm in debt. I've got my own student loans. I've got a big mortgage. I have all these expenses. I'm surely going to get financial aid. And that's the school. The school is not there to help you figure out how your child can afford to go there, right? The school is there to maximize their revenue. They're basically a business. Mm-hmm. And they're there to give you the least amount of financial aid that's going to get you to enroll your child at their school and say that you'll pay them for 4 more years.
Wow.
And what I'm hearing is that this is not a situation where you can stick your head in the sand and, like you said, hope for the best. We all know that the system is broken. I think you've alluded to it in talking about the formula. That $100,000 was a perfect example where it's like, I can't shovel off this money. Other things that I've seen is, someone who's made 30 or 40 grand for quite a long time in their life. And then all of a sudden, finally get promoted. And, after years and years of working, and they've only been earning a good income for 3 or 4 years. Well, that income on paper is the income, like you said, that they're going off of, but you haven't had 18 years to save up because your income didn't look like that for the last 18 years while you were bringing up a child. So we are in no way blaming the parents. We're just saying that the system is broken. You need to understand that it's broken and then make the best decisions that you can on behalf of your children. And I mean, it's the same thing as it pertains to student loans. We know the system is broken, but we've got to work within the rules and the regulations that exist and make the most out of our situations based on that.
I totally agree. And I think there are options for parents who want to do it smartly. Even if they can't get, a lot of need-based financial aid, or even if their child is sort of more of an average student and they're not going to get a lot of merit-based financial aid. I think there are good options. And I hope, my kids are 8 and 10, that in the next 10 years, more better options come out, with online school or, community colleges that feed directly into 4-year colleges and a lot more, sort of, I don't know if free community college for all is going to happen, but I think there is, I guess, impetus for things to change. The financial aid formula is changing. The stuff that was supposed to go in for this year is been pushed off, but there are changes afoot, and I think there's momentum for change. And I just hope people continue to read up on it and keep abreast of the most recent changes.
Yeah. Well, thanks. That was great information, Nannette.
Thank you.
And so I want to segue a little bit into student loans. So Lauryn, I know this is your category, but there are so many different types of student loans, but the two major categories are federal and private. So can you kind of explain, just for the listeners, what the difference is, and just a little bit about, some of the pros and cons there?
Yeah, so I'll try to frame it, initially too, since we just got done talking about college funding, et cetera, is like undergraduate versus graduate are two different things. And so when we think about funding undergraduate education, undergraduate student can take out about $30,000 of student loan debt from a federal standpoint. And the benefit to taking out federal debt is that you're going to have a lot more options available. It is going to come at a higher interest rate usually than private debt will be. But when we think about federal debt, it's like, well, I have these extra options available to me, but I also am limited in the amount that I can take. This is where, like I said, college planning becomes so important. Now, on the other hand, you have private debt. And so if we're thinking private debt and you're thinking private debt for undergraduate schools, that means you've gone and you've maxed out that 30 grand, which is only, like I said, like $5 or $6 grand per year. And you have a lot more above and beyond. Anything above and beyond your 30,000 that you can take for undergraduate school, you're going to be taking on private debt. So the big thing I would caution a parent listening or someone who is a high school student listening is that you take on that private debt. The only thing that you can do with private debt is pay it back. There's not income-driven repayment options. There's not deference and forbearance and all these different things that you hear about, forgiveness. With private student loans, it is pay your loans back. And you've got to figure out how to do that. And the hardest thing about the private student loans is, like I said, if you finish an undergraduate degree, your income is going to be limited in some capacity to, what an undergraduate degree allows you to earn. So you took out $200,000 of private student loan debt, you're going to have a pretty hefty monthly bill as a 21-year-old coming out of school. And there's not a lot of ability to be able to switch that up into something that's going to be affordable on a monthly basis. So you might find yourself having your whole paycheck go toward your private student loans because of a decision that you made to take on that private debt. So be very, very careful about taking private student loan debt as an undergraduate student and in general, because like I said, your only option is to pay that debt back. Federal, on the other hand, like I said, you're going to have options for income-driven repayment plans, forgiveness, public service loan forgiveness. You're going to have 3 years of forbearance. There's deferment if you're in a tough situation. There's just a lot more flexibility, as life kind of throws you various curveballs, or you're trying to get your footing and financial stability up underneath you. So those are kind of the two big differences. And one other thing I'll say about federal versus private is that federal will pass away with you should you pass away, whereas private debt, they're going to try to collect that money from your estate.
Yeah, thanks. And so I know something that people talk about, and we've even mentioned it here, with your first client that you got, you had someone that had student loans that were 3 times, their income. And so how can you determine if paying back student loans is realistic, and what are your options?
Yeah. So, if you're listening right now and your student loan debt is more than 1.25 times what you earn, then you are likely a good candidate for forgiveness. So what is forgiveness? So first, you have to have federal loans to even be thinking about forgiveness. We just talked about private not having very many options. So you want to avoid private debt as much as possible. When we think about forgiveness, there is what we call taxable forgiveness. And then there is tax-free forgiveness, which means you qualify for something like public service loan forgiveness. So I'm going to speak to the broader audience of people who are probably not working in public service, just have a normal job, went to graduate school, have 6-figure student loan debt, maybe don't have 6-figure income. So take your student loan debt, 1.25 times your earnings, look at the difference ratio in that. So as an example, let's just make it to be clear. You earn $50,000 of income and you have $100,000 of student loan debt. That is more than 1.25. It's actually double what you owe, double what you earn. You're a good candidate for forgiveness. And what you would do is get on an income-driven repayment plan. So IDR, income-driven repayment, is the name of the program within the federal government. And they're going to allow you to choose one of 4 different options. So that's ICR, IBR, PAYE, and REPAYE. So you can see why it gets very convoluted and people just like, hit their head and it's like, I quit. A lot of people get on with one of the 4 that I just named, which is called income-based repayment, thinking that that's the only plan available to them. But there's actually 4 different options within the income-driven repayment programs. So you pick a program based on your income, they calculate a payment, and either after 20 or 25 years, your loans are forgiven. Now, the problem with that is that, like I said, if you have $50K of income, they're going to calculate a payment based on that $50,000. It's going to be pretty low payment. It may not be enough to cover the interest on a monthly basis that is accruing, and that's going to cause your student loan to get larger. So this year you owe $100,000, next year you owe $108,000, the following year $116,000, and so on and so forth, because your interest is steadily accruing at 7 or 8%, and you're paying very, very little on the loan. So at the end of the 25 years, your loans might be $300,000, even though you borrowed $100,000. Super duper scary for some people. But that is actually how the program is meant to work. Like I said, we are all admitting that our education program is broken, but within the parameters of what we can do right now, you wait that 20 or 25 years. At that point, that $300,000 in my example is going to be forgiven. The government is going to say, hey, you don't need to pay us this $300,000. You've paid based on your income and affordable amount for the last 20 years as we asked you to. So don't worry about this. However, we're going to put that $300,000 on your tax return as if you earned an additional $300,000 this year. So what you need to be doing right now is saving up for the tax liability associated with you being on one of those income-driven repayment plans. So if you're not doing that, and which most people are not, that is something that you want to get to the bottom of what that calculation looks like and how you can start setting some money aside so that you don't get whammied by the IRS in 20 or 25 years, or for however long you've already been on your income-driven repayment plan.
Yes, and that is a lot. And this is why we need people like Lauryn. But if you are in that situation where you have student loans that are a lot higher than what you're making, I highly encourage you to talk to a student loan expert like Lauryn to help you figure out what's the best repayment plan and kind of some of the things that you need to look out for. And one of the things too that I see a lot is, there's consolidating student loans and then there's refinancing student loan. Are you okay?
Yeah, it was like somebody was like throwing something on my porch. I was like, what is this noise? And then I heard like someone talking, but they never knocked. It was the Amazon person. So.
Oh, okay. Okay. Well, yeah, we got it. That's for our editor.
Yeah. Totally thrown. I was just like, what? And then she just like slammed the gate. There was a lot happening.
I'm like, is somebody breaking in her house or what's going on? Okay. But we hear the terms consolidating and refinancing often. And I think people get those mixed up, and sometimes they might accidentally do the wrong thing. And so can you kind of explain the difference between those two and what that really means?
Yes, I will try to be more brief this time. I just get really excited about student loans. And if this is the one time that someone's going to be listening, I want them to get all the information so that they at least know where they, can know better so they can do better. All right. Consolidating versus refinancing. In general, in the world, those words can be interchangeable, but with student loans, they are not. So consolidating refers to taking all of your federal loans. You have this big, long list of loans. If you log in to your various loan servicers, or if you log in at studentaid.gov, and squishing them all down into 1 or 2 line items. So it'll say direct consolidated subsidized, direct consolidated unsubsidized, depending on what type of loans you have. You may even be able to consolidate them all into one because you don't have any subsidized loans, as an example. So when you consolidate them, you have created effectively a new loan, but it's still a federal loan. And so that's going to give you still access to the income-driven repayment plans, to the extended and the graduated plan. You're still going to have federal loans that are eligible for all the federal programming. Refinancing, on the other hand, is going to be taking your loans out of the federal system if they're federal, or if they're already private, just like a mortgage. You already have a mortgage, you're going to refinance it. You're trying to get a lower interest rate, or you're trying to change the payment terms. So as we think about mortgages, this is something that a lot of people are doing right now. They might be going from a 30-year term down to a 15-year. They're going to have a higher mortgage payment because they have less amount of time to pay it off. Sometimes you want to refinance and stretch it back out. So, you've been paying for 7 or 8 years and you want to go back to 30 years. You refinance, you're going to have a lower monthly payment because you have a longer term, but you're also going to pay more interest over that period of time. It works the same way with student loans. So refinancing is something that you do because you want a lower interest rate and because you know that you can pay your loans off. So your main intent is to get to a zero balance and say, I have paid my loans in full, and I want to do that in the most cost-effective way. So I'm going to refinance my loans. Consolidating is not refinancing. You do not get a better interest rate when you consolidate. They take the weighted average of all the loans that you have in the federal system and you squish them down. The benefits to consolidation within the federal system is sometimes people have old loans called FFEL loans, which are not eligible for all the programs that exist. Another reason you might want to consolidate is if you're fresh out of school and you are eligible for something like public service loan forgiveness. You want to get rid of your grace period faster and get to paying your loans. And then the other thing too is that you might have multiple different servicers. So maybe your loans are at Great Lakes, Nannette, and Navient. You just want to have them all at one place. You can consolidate them and put them all at one servicer and make your life a lot simpler, have one, easy monthly payment. So consolidating happens in the federal system. Refinancing happens outside of the federal system. And once you're outside of the federal system, there's no going back. So you want to be very careful before you refinance your loans.
Yeah, that's super important. Thanks, Lauryn. And so I wanted to ask this question both to Nannette and Lauryn, because I'm interested to hear your perspectives. What should borrowers consider, like if they decide they want to go back to school for another degree? So like when you think about, like parents or, just young professionals that we're working with that want to go to grad school, how do you think about planning for that?
I'm going to go to Nannette first.
Oh gosh, I have so many things to say. So I'm still paying off my grad school loans for my expensive MBA. And if you ask me if it was worth it, probably not. So I would say fully understand whether the graduate degree is worth it. I know lots of people who get grad degrees in underwater basket weaving, and then they owe $150,000 for grad school, and they spend their lives paying it off. So graduate school is like this whole new ball of wax. And you can, like Lauryn said, in undergrad, it's really hard to get yourself in big trouble with federal loans, right? With graduate school, it's a different story. You can get yourself in trouble with federal loans in graduate school easily, just like you can with private. And so that doesn't make it better. So it's about, understanding the degree you're getting. Is it going to be worth it? What's your plan for paying off the loans? I have a friend who's a social worker. She had to get a master's degree, but she's still only making $35,000. Is that worth it? I don't know. Then you have to think about public service and all that other stuff. So that's what I tell people with regards to grad school. When I talk to parents, don't pay for your children's grad school. Don't pay for your children's grad school. I understand you feel guilty and you want to pay for undergrad. Don't pay for grad school. That is they are an adult. It's their decision to make. They need to understand if that's something that they should do for their long-term financial security. You don't pay for your kids' grad school.
Amen, amen, and amen. And while we're on the subject, one thing we didn't talk about with undergrad was one other option that exists. So there's federal for the student. There's private, if you decide to make that the burden of your child to carry, above that, like I said, that small amount of federal that you're allowed to take. But then there's also parent plus loans. So when Nannette was just saying, maybe you pay for your kids' undergraduate if you, didn't have a situation where you were able to pay out of pocket. What a lot of parents are doing are taking on what we call parent plus loans, which come at like a 8% interest rate. And they're going to be federal loans, but they're also going to have a lot more restrictions, and they're in the parents' names. Yes. So what a lot of parents are doing, I'll just take on the $200,000-$300,000 of debt for you, child. Your child has no responsibility to pay that debt. It is your full responsibility. Those income-driven plans that I referred to are going to be based off of your income, not your child's income. And if you have a higher income because you've been working 20 years or so and your kid comes out of school making $30,000 a year, you may say, I don't want to pay this. It's your responsibility, kid. One, they don't have the obligation to, but two, they may just not be able to afford to because your income is so high that it's going to calculate a payment that's just not affordable for them on a monthly basis. So there are a lot of things to think about. And then you're taking that on for maybe another 20 or 25 years if you choose to do income driven, or if it even works out for you to do income driven repayments. And what are you sacrificing along the way? It's probably your retirement.
Yeah. And they will garnish your Social Security check to pay Parent Plus loans. Don't borrow Parent Plus loans ever.
Yeah. Yeah. I just found out about the Social Security wage garnishment.
Yes. Like the student loan crisis has officially hit older people, like older Americans, and parents. They sign on the dotted line and they just don't understand. All you need is a pulse to qualify for a Parent Plus loan, basically. And they will let you, like, they don't care how much you earn, whether you can pay it back. Like they just don't, like the government doesn't care. And that's a huge failing of our system.
A huge failing.
So any final thoughts or pieces of advice for the audience? And I'll start with you, Nannette.
Oh, gosh. I've just given my best pieces of advice. Let's see. Stay away from Parent Plus loans.
Should we pay for grad school?
No, don't pay for grad school. Don't, just don't assume that the school has your best interests at heart, because they don't. And parents really need to be their own best advocate, right? Because the government and the schools, they don't have your best interests at heart. They're not there to give your child a free education. And it's so important for people to learn about the system, either by, reading books or articles, or, just don't. The school financial aid night is not the place to go to learn, because they're not there to help you figure out what's right for your family financially. They're just not. And so I think it's really incumbent upon parents to educate themselves.
Yeah, if there was ever a time to invest in the help of an expert, it would be to make sure you figure this out in the way that's going to be most fitting for your family, because you could dig a really big hole and not be doing that intentionally. I've seen $500,000-$600,000 of Parent Plus loans.
Yes.
I've seen $500,000-$600,000 of individual graduate school loans as well. I've seen it also, we didn't talk about, was public service loan forgiveness. People who don't believe that it is a real program and have bailed out on it, and are struggling financially on a monthly basis because they now have private debt with no options, because they listened to somebody who said that the program was not real when it was the thing that they probably needed to depend on the most. And so, as I close out and I think about, we didn't talk very much about public service loan forgiveness. It is a program for those who work at nonprofit organizations and also government agencies. So good indicator if you're not sure if your company does or not. Like you said, sometimes people know it's a nonprofit or a government agency, but you're like, I'm not sure. We seem kind of public. But if you have a 403B, that might be a reason that, like, oh, okay, maybe my company, that's your retirement plan. But a lot of 403Bs go with companies that are also going to qualify for public service. So that might be one hint, but just go ask your HR department whether you qualify or not. They've probably filled out what we call the employer certification form for someone else, if they are in fact qualified for public service. But it's a 10-year program. 120 payments. You don't need to do them all consecutively at one company. So you can go to, government agency X, take a break for 2 years and go to a private company, those 2 years don't count. And then maybe you pick up somewhere else and go 8 years to a nonprofit organization. At the point at which you get 120 payments while working at a qualified employer, you're going to get your loans forgiveness. And so if you remember earlier, when I talked about taxable forgiveness, it was either 20 or 25 years. Well, public service loan forgiveness is 10 years. So imagine the amount of money that you're going to save by paying for 15 years less than you would have if you didn't have this program available to you. So it is not fake. It is not a scam. People are actually getting forgiveness. You need to understand the criteria. To break it down briefly, there are 4 of them: direct loans, being on an income-driven repayment plan, working at a qualifying employer, and then making those 120 payments. If you do those 4 things, public service will be available to you at the end of that 120 payment period. So do not put yourself in financial distress because of what someone who is not an expert has said or what some clickbaity article has told you, but invest the dollars in getting some sort of expert to help you sort through your personal situation, because every single person is different.
Yeah, that's a great point, Lauryn. And I hear that from parents all the time too. Like, oh, well, we heard from so-and-so that this school gives this kind of financial aid and blah, 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 blah. Or the school, the high school counselor told him this about this. And that's the thing, like, you need somebody who knows about your particular situation, and they need to be an expert.
Yeah. And two takeaways that I have just from listening to the two of you. Number one is just don't bury your head in the sand when it comes to college planning or student loan repayments. A lot of people just want to, ignore it and think it'll fix itself. And that's not the case. And then also just leaning on the advice of experts and trying to come up with a plan that's personalized for you. And I think that applies to anything, any kind of financial advice. There's so much information out there. But, we don't all know if it's, from reputable people, and then we all don't know how to apply it to our personal situation. So it really pays, like getting professional advice pays for itself. So thank you so much. Nannette, how can listeners get in touch with you if you have questions or need help?
It would be great. People can reach out to me via our website at www.cultivatingwealth.com. I'm available on there. We do offer a free introductory phone call to see if we might be able to help. What I love to do is just give people quick information, even if they don't need our services. Sometimes I can tell people an answer within 15 minutes, in a quick intro call, and it really sets them on the right path. So please feel free to reach out.
Awesome. All right. So we'll get to today's money quote. And this is a very interesting one. Lauryn and I were kind of laughing about it because it's kind of unusual it's from Dr. Martin Luther King. And so it's not burn, baby, burn, but learn, baby, learn so that you can earn, baby, earn.
I just love this quote because I just, like what you heard of Dr. Martin Luther King Jr. and, like personality wise, all the depictions that I've seen. Obviously, I wasn't alive when he was alive, but this sounds like a very playful, fun, kind of quote. And I was like, oh, this doesn't sound like his personality as per the perspective that I've been given. Very regal, well put together, articulate. It's like, this is a fun quote, but I could totally also see, this being said. So, I mean, it's so true. So yeah. It's not burn, baby, burn, but learn, baby, learn so that you can earn, baby, earn. It's going to be my new favorite MLK quote.
All right. Well, join us for the next episode. We're kind of wrapping up the end of our series. And so I'll have to say goodbye after the last couple of episodes, but the next one is life insurance and annuity. So Lauryn and I are going to dig into all of the details about those topics and kind of answer some questions there. And so we look forward to speaking with you then.
Ciao for now.